Welcome back to Finance in Focus, where we break down what's happening in the financial world and explain the facts behind today's biggest headlines. I'm Brady Hansman, and let's take a look at what's driving the markets today. We're going to be taking a closer look at a new framework introduced by Vanguard called the BETR calculation, short for break-even tax rate. Now, this is a method designed to more precisely evaluate whether converting a traditional IRA to a Roth IRA produces a higher after-tax outcome over time. This video will focus only on what the BETR calculation is, why Vanguard created it, and how it works and what it changes compared to older rules of thumb. Historically, Roth conversion decisions have often been based on a simple comparison. If your future tax rate is expected to be higher than your current tax rate, converting is thought to be beneficial. If your future tax rate is expected to be lower, converting is thought to be unfavorable. This approach treats the decision as a direct comparison between two tax brackets. Now, Vanguard's research found that this rule often oversimplifies the problem because it ignores several important variables that affects the final after-tax outcome. These include where the conversion taxes are paid from, whether part of the IRA already consists of after-tax contributions, the time horizon until distribution, and how taxable accounts used to pay the tax are invested. Because of this, Vanguard introduced a more precise concept, the break-even tax rate, or better known as BETR. The break-even tax rate is defined as the exact future effective tax rate at which the after-tax value of converting now is equal to the after-tax value of not converting. In other words, BETR identifies the specific future tax rate where both choices lead to the same financial after-tax result. This refrains from the question. Instead of asking, will my future tax rate be higher or lower than today, BETR asks, at what future tax rate do these two strategies become equal? If your future effective tax rate is higher than the BETR, the conversion produces a higher after-tax outcome. If it is lower than the BETR, not converting produces a higher after-tax outcome. So the key difference is the BETR incorporates multiple real-world factors that traditional rules ignore. Vanguard highlights several variables that directly affect the break-even rate. First, where the conversion tax is paid from. If the tax is paid from the IRA itself, the converted amount is smaller. If the tax is paid from a separate taxable account, the Roth conversion can be compound on a larger base. This alone can materially change the break-even tax rate. Second, after-tax basis in the IRA. If part of the traditional IRA consists of non-deductible after-tax contributions, only the pre-tax portion is taxed at the conversion. This lowers the effective tax cost and lowers the BETR. Third, time horizon. The longer the time between conversions and distributions, the more tax-free growth can accumulate in a Roth account. Longer horizons tend to lower the break-even tax rate. Fourth, tax efficiency of the taxable account used to pay the tax. If a taxable account used to pay conversion taxes is invested in tax inefficient assets, the opportunity cost of using the account is higher. This also affects the BETR. Finally, future Roth contribution flexibility. In some cases, reducing pre-tax IRA balances through conversions can allow future backdoor Roth contributions that were previously blocked. Now, Vanguard's framework incorporates these effects into a single break-even rate. Under the traditional approach, the decision is binary. Future tax rate higher today, convert. Future tax rate lower today, don't convert. Under the BETR framework, the comparison is more precise. You compare your expected future effective tax rate to your calculated break-even tax rate. If future taxes exceed BETR, conversions produced a higher after-tax result. If future tax rates are below BETR, not converting produces a higher after-tax result. This means the correct decision can differ from what a simple bracket comparison would suggest. Two people with the same current and future tax brackets can have a different BETRs depending on the following: how they pay the tax, how long the money compound, and what type of assets they hold elsewhere. The BETR calculation does not predict future tax law. It does not forecast tax brackets, and it does not assign probabilities. It simply identifies the tax rate at which two strategies become equal based on a defined set of assumptions. The output is not a recommendation, it is a neutral mathematical threshold. To summarize, BETR stands for break-even tax rate. It identifies the future tax rate where converting and not converting lead to the same after-tax result. It incorporates tax payment source, IRA basis, time horizon, and asset tax efficiency. And it replaces a simple rule of thumb with more precise break-even framework. I hope you enjoyed this episode. If you did, make sure to like and subscribe to stay up to date with new content. Once again, this is Finance in Focus, designed for educational and informational purposes only, not investment advice. Thanks for watching.